Banking is broken, and we may not be able to fix it. An extremely significant sector of the economy, banking is built on a fairly straightforward idea. People with more money than they know what to do with can invest it in a reliable organization that can lend it to others who have great ideas but lack the resources to put them into action. They make a profit for the service they provide as a financial intermediary by offering a modest incentive to the depositors while charging a bigger premium to the borrowers. With factors like fractional reserve banking and alternate capital sources, this system has grown more sophisticated throughout time. But if we take all of that away, we will discover that the core of banking is this straightforward operation. Despite all the criticism banks receive, they may be very beneficial to those looking for a secure location to store their money. They provide an almost 100% assurance that the funds entrusted to them will remain there days, months, or centuries after being deposited. They also make money easily accessible to anyone who needs to borrow money online, over the phone, or at a number of ATMs, or just by using a debit card made of plastic. They are also the institution to turn to if you want a fair loan that adheres to long-established lending criteria. Even while we dislike things like credit scores and employment verifications, they contribute to the fact that so many homeowners are currently paying mortgages with interest rates below 3%. Banks are experts at reducing risk by ensuring that everything is consistent. Home loans, one of the most customized financial instruments imaginable, can even be bought and sold like commodities on financial markets since they are so uniform. But even securitization, which sparked the world financial catastrophe, cannot be blamed for the problems with modern banking. Today's banking industry is struggling because it has grown so centralized that it is unable to fulfill its function as a financial middleman. In order to understand how the last financial crisis led us down a path that profoundly damaged banking to the point where we may no longer be able to mend it, it is necessary to understand how money functions. The current banking problem actually began in the middle of the 1990s. The majority of entry-level bankers' decision-making was being replaced at the time by computers. Prior to this, getting a loan to launch a business or purchase a property depended entirely on your connection with a local bank manager. In their office, a manager would sit down with a prospective applicant and go over the basics. Have you got a job? Have you saved any money? Do you have any additional resources? Anything that banks still consider today. But this entire procedure also has a very personal component. A bank manager might genuinely ask someone's parents to attest for them. This endorsement would have no legal consequences, but it may imply that if the same parents sought to take out a loan to buy a beach house or an RV, and their children were behind on their payments, they might be turned down. All in all, despite the fact that it was quite informal, it worked, but it gave the bank issues. Given the duties they would directly assume, the first issue was the cost of bank management. They were highly regarded professionals in their judgments to lend or not lend money. A bank manager nowadays is essentially a glorified credit card salesperson. A bank manager was previously compensated and respected on par with a judge or doctor. Scalability was another issue that the banks faced as a result. It would be impossible for a bank to operate if it decided to relocate to a new city without the fundamental data they need. Someone with bad credit could stroll into the new branch and walk out with a loan and then default on their new loan. As a result of the established bank knowing better than to refuse to lend money to dodgy Doug down the street, the new bank loses money that it would not have made. Fortunately for banks, These issues were remedied as computers, and most importantly, credit scores, became extensively used. Prior to 1989, credit ratings did not exist as we know them today. At this point, establishing a relationship with a bank has essentially been supplanted by your credit score. Today, a bank manager only needs to read a number from your publicly accessible credit file to discover everything they need to know about you. Even if credit reports have their own issues, for the time being, I'm going to overlook them because, like it or not, they are here to stay. To use this data pool to make financial judgments is simply too convenient and lucrative for the banks. The use of computers and international connections has further simplified this. A home loan application can now be submitted in one of three ways: online, in person at a branch, or through a mortgage broker. If you submit an online application, a ton of information will need to be filled out, which will then be converted into data points and forwarded to an assessor. The same process occurs whether you use a bank branch or mortgage broker, except that an employee of the bank or broker fills out your information this time. Everything always ends up in the same place, usually an assessment office in a low-wage country such as India or the Philippines. The approval of financial applications has simplified to the point where modern banks have been able to relocate their offices there. These offices' staff only needs to confirm the accuracy of the information submitted to them by cross-referencing it with official documents, after which they plug that information into an algorithm to determine whether to approve or reject the application. It's a brilliant solution that makes it possible to process much more applications for much less money. The good news is that some of those cost savings have been passed on to customers, as I mentioned at the beginning of this video, but that's about where it stops. Around 20 sizable banks competed for market domination in the United States in the early 1990s. There are just 4 right now. Major full-service banks have consolidated over time through a number of mergers, acquisitions, and bankruptcies. Even before taking into account the benefits of operational costs, huge banks want to ensure their operations are reasonably standard. So giving the decision-making process to one piece of software rather than thousands of bank employees merely makes good financial sense. However, as is the case with many things, what is sensible for business is not always sensible for society as a whole. Once more, I'm going to ignore the problems associated with credit scores. I don't want to say too much that you probably already know, because there are so many videos discussing how bad they are. I do want to concentrate on something else though. There are people today who have excellent credit, healthy assets, and a steady salary, yet nevertheless struggle to secure a loan. Why? Because their financial status deviates from the strict guidelines of the bank's automated structure. A person with irregular full-time employment is ideal for a bank application because they only need to include one piece of information in the income section: their salary. But what about those who rely on gratuities, royalties, investment returns, rent, business profits, or even government benefits for their income? What about them? As is the case with many former police and military personnel, this is what is referred to as supplementary income in the banking industry, but big banks aren't especially fond of it. Why? Because it necessitates some critical thinking that is beyond the capabilities of this automated method. Ironically, many of these revenue checks can be more stable and reliable than a paycheck, but because a computer can't comprehend that numerous sources of income don't yield a single tidy sum each year, it can only do one of two things: Ideally, the people entering the data into the computer will be instructed to be extremely cautious. The bank will frequently use the $50,000 amount if you made $50,000 off of your business in 2019 and $500,000 off of it in 2020. The major banks just won't accept these sorts of income, leading customers to other lenders with less stringent requirements, but considerably high interest rates. Interestingly, this will frequently be the very same bank or even just a bank subsidiary. The main distinction being that they demand a premium for various factors. Previously known as subprime products, the term has fallen out of favor, and banks now refer to these loans as non-prime or non-conforming. The problem this creates is that it can force people into just getting a regular job, over building out their business, or pursuing some other profitable endeavor. Non-conforming is really the right word for these types of loans because, as I said earlier, you will often find that the people that are forced to take out these loans in order to buy a house are in far better financial positions than your regular salaryman. Even in the greatest of circumstances, starting a business is risky. The best approach to reduce that risk is to make sure that your personal finances outside of the business are in excellent shape. Without owning a property, it is incredibly difficult to establish oneself in a strong financial position, yet it is possible to be financially stable while renting. It's simply a lot harder, of course. An American family with a home they own has a median net worth of $255,000. According to a 2020 survey, the median net worth of a household that rents is only $6,300. Simply because they don't want to miss out on the chance to buy their own home, many talented individuals are compelled back into the regular workforce. Unfortunately, the bad news doesn't stop for those who do manage to persevere and launch their own business. One of the top academics studying the function of banks in the modern world is Dr. Richard Werner. He has expressed concerns about most of the topics I have addressed in this video, but over the past 20 years, the largest warning he has issued has been that large, consolidated banks are becoming less eager to lend money to businesses. Lending to businesses is fundamentally more challenging than lending to consumers or homeowners. The bank will still have a property to sell if a mortgage is in default in order to recover some or all of their losses. If a company fails, a bank will most likely never see that money again. Furthermore, enterprises are significantly more complicated. The health of a business would need to be evaluated by a bank in an effort to reduce risk, which is quite challenging. Without a doubt, it goes well beyond the parameters of the regular procedure for mortgage applications. A large bank views a non-standardized process as being expensive. It may cost the bank more in assessment fees than they could ever expect to recoup in interest if someone applied for a $100,000 loan to operate a second store in a new city. This implies that some banks will not even consider lending to small businesses, and those that do will charge substantially higher interest rates to cover the cost of assessing these loans. Small businesses play a crucial role in the economy's overall health. Businesses could acquire the capital they needed when banks were smaller and approval procedures were far more individualized as long as a business proposal made sense to the bank manager. Big banks today only want to lend to large corporations. This graph compares mortgage lending to non-mortgage lending in relation to the American GDP. Keep in mind that the non-mortgage lending plateaued in the 1990s, at the same time that mortgage lending increased. Due to the increased use of credit cards, auto loans and personal loans during that time, this standstill was even more severe than it might have appeared, implying that a smaller slice of this stagnant pie is made up by traditional business loans. Large corporations have a natural preference for items that are homogeneous, generic, and simple to copy. This is typically acceptable since it allows smaller firms to carve out a niche for themselves and offer more unique items. Unfortunately, it is nearly impossible to break into retail banking, and even if a small bank succeeds, it will usually wind up being acquired. For the vast majority of typical consumers, breaking up banks is also quite challenging. In comparison to smaller banks, big banks provide greater services, better accessibility, and better goods. The normal consumer also doesn't want to wake up one day and discover that their Citi checking account is now with a different organization since Citigroup was split up. It would be inconvenient and would damage people's trust in the financial system. Therefore, it appears that banks' roles as financial intermediaries will continue to be focused on initiatives worthy of the attention of some of the world's largest corporations. If you enjoyed this video, be sure to check out our other videos as well. Also, leave a comment and click the thumbs up button. Additionally, don't forget to subscribe. I appreciate you watching. I hope to see you on the next one.